Hello, everybody. Welcome to TGG's Bonfire Chat. Today's topic is taxes are certain, changes everybody should know. For everybody that's first-time attendees, this is our 8th Bonfire Chat where Matt and crew discuss different key business issues that are going on in today's landscape and how business owners should navigate those waters. My name is Robert Rodrigues, and I have the pleasure of speaking with our founder and CEO, Mr. Matt Garrett. Thank you, Matt, for joining today and spreading some knowledge when it comes to taxes for business owners.
Thanks, Rob. I'm excited to be here today. It should be a fun one.
Yeah, definitely excited as well. For those also who don't know, TGG is a leading provider for outsourced accounting. But when we look at outsourced accounting, TGG is much more than just a provider of accounting. We talk about this vendor versus strategic partner. And we really like to be that extension to our clients' teams, really helping them not just provide accurate and timely financials, but navigating the waters of small to medium-sized businesses, dealing with items like today, taxes, like the ever-changing environments that are going through. So if anyone ever wants to speak with us, feel free to reach out at the very end. We're going to give some contact information and hopefully we'll provide some great value to you guys today. But the goal for the webinar today is really to share our knowledge and experience that Matt has so graciously done a lot of due diligence on when it comes to taxes and how it applies to your business specifically. So more to that small to medium-sized business and kind of that economic environment. Also at the very end, we are going to open it up to questions. So if you have any questions, feel free to throw them in the chat and Matt and I will kind of jump into those at the end. But I guess jumping right into it, Matt, to kick things off. So what are you kind of seeing in the world with small businesses today when it comes to the tax law changes and things that we should be looking at?
Well, yeah, there's a bunch of tax law changes that I think are going to affect small businesses going forward. We had all of those tax changes that happened in 2020 with the pandemic. We had the stimulus packages, and then we had the infrastructure bill passed. So there's a bunch of stuff in there that is either expiring, changing, whatever, but a whole host of things that are going to be out there. I also do want to mention as well, Rob, that we don't do taxes. So we are, in fact, I'm speaking to you as a CFO, as opposed to speaking to you guys today as someone who's preparing taxes. This is just stuff that I'm looking at as like, how do we find ways to make money as business owners in this thing? And there's a bunch of stuff out there.
Yeah, and I think that's real applicable because you know, it's key to talk to our CPAs to stay ahead of the curve, understanding that. But there's a big difference between tax accounting and managerial accounting and running your books by the numbers and understanding how those numbers affect, you know, your day-to-day operation. So I think today, you know, focusing on some of those tax changes that we can then apply to our business will be key for all the business owners on our call today.
Yeah, absolutely, Rob. I think, again, I want to encourage everybody. Our best practice, our TGG Way best practice here for our clients is to make sure that we're meeting with the tax CPAs at least semi-annually and preferably quarterly, so that we can kind of prepare way before year end and not in a big, you know, massive rush to try to do expenses or account for things. But what we're really focused on today are tax law changes and what it means for the business, because I think every business right now is facing 3 or 4 major challenges. One being obviously inflation. Inflation is a massive problem right now. The core CPI was up 7.9% in February. PPI, which is the producer price index, was up 10% over a year. So this is a major price increase for everybody in one way, shape, or form. What are we doing and how do we handle some of that stuff? I think 2 is supply chain issues are still big issues. 3, I think this changing workforce is a massive change, both inflation on the wages, but also just the fact that people really want to work remotely and want flexibility and this great resignation, you know, that's going on. So I'm going to try to frame a lot of these tax law changes in ways that we can take that and use that to kind of fit into the current landscape and challenges that we're all facing.
Yeah, I think you hit the nail on the head with those fringe benefits. How do we adjust to inflation, but benefit our employees in an ever-changing environment.
Yeah, that's for sure.
So when you look at it, what are some positive tax changes that you've seen for small businesses in the last kind of 6 to 12 months?
Well, there's a bunch. One that is sort of the most obvious that I think most of your CPAs are going to catch, but I want to make sure we make a big deal out of this, is the Section 199A. And this is for pass-through entities. So S Corps, LLCs, partnerships, sole proprietorships, all that kind of stuff. Regardless of that type of an entity, the old tax law, the Trump law that he passed in 2018, you had to be like a manufacturing firm. You couldn't be a service firm and get that 20% reduction in your share of your business income. That's changed for 2022. So again, we just want to make sure that everybody's aware of that and commenting on that with their CPA, because it is a change for 2022, and it's a 20% tax deduction on your share of business income up to $170,000 in 2022, or if you're filing jointly, up to $340,000 of business income. So again, a 20% reduction is somewhere between a $34,000, or if you're filing jointly, a $70,000, almost a $70,000 reduction in your business income, which again is going to result in tax savings at just using a 50% bracket, somewhere between $17,000 all the way up to maybe even as much as $35,000. So big deal there. The other thing to think about here is the C corporation rate. So the taxes on C corporations and income inside of a C corp is 21%. And it's really easy to think, well, I'm in a pass through, so I'm getting taxed at 37% federally. I could go to a C corp and tax at 21%. Again, I'm taking all the state income taxes out of this, just talking about federal here. But what you've got to think through is, if I'm then going to pay dividends on the money that's coming out of the C corporation, I got to layer on an additional 15 to 20% depending on my income. So I could be as high as 41% as opposed to 37% on a straight pass through. So C corps still don't quite make sense. But this is a really important conversation to be having, is what type of an entity do I have? What are the tax ramifications of having that entity? And then if I want to sell in the future, what's going to happen with this entity as well? So those are things to constantly be kind of mindful of as we're talking about some of these initial, changes.
And the benefit here also is the fact that it's now spanned over multiple industries, not just that manufacturing. So for instance, us being a service business, we can now take advantage of this tax change, correct?
That's right. And that's the big change. We never got, like, us poor accountants, right? But accountants, lawyers, engineers, architecture firms, things like that, professional services firms couldn't take advantage of this in the past, and they can now. So it's something to definitely be mindful of. It's not a disadvantage anymore to be in that service business. So that's good.
Nice. And so do you see a lot of CPAs understanding this, or is this something that they should bring to the table?
Again, I wanted to start off with something that was a bit obvious, but I think that because, I see most CPAs absolutely understanding this, but a business owner has to be mindful. Look, the tax code is 22,000 pages long. Okay, that's insane. You can't expect anyone, let alone a great CPA, still is going to have trouble remembering all of that stuff. And so I think it's important that business owners are educated on this too, not just to make sure that they're in the conversation. But like I said, Rob, I think the real part of this conversation is, why are you an S Corp? Why are you an LLC? Why are you a C Corp? Don't just do it one time and then forget it because your lawyer told you to 10 years ago. Let's take a look at this and constantly looking at, where are your goals? Where are you going? What are the tax laws that are affecting this? And is there a better form of our entity to be in order to take advantage of some of these changing tax laws?
Yeah, it's not just looking at the past when you originally filed, but today as well as in the future and where you're trying to take the company.
Yeah, that's exactly right. And I just think, unfortunately, as a business owner, I've suffered with this too, and haven't really paid attention to my entity type. It's like, okay, I have an S Corp. All right. Like, why? I think
now you're stuck in the S Corp for the rest of your life, handcuffed there. Don't ever change it.
Yeah, no, the good news is you're not stuck, but I know that was a joke. But I think the good news about it is that as these tax laws change, it's a great impetus to be like, okay, why am I doing this? And really start to have that goal conversation, that strategy conversation of where are we going as an entity. Definitely.
When we first kind of kicked it off, we talked a little bit about kind of those fringe benefits. What are some changes that you've seen to kind of the bonus depreciation? I know that was a big change that I think is very applicable to our business owners. Yeah, I mean, look, a lot of people, there's two things that are changing here.
that are really important. One is Section 179 and one is bonus depreciation. Often those two kind of get mixed as the same thing, and they're not, right? Section 179 is the ability to write off up to, in 2022, just over $1 million. They increased it from $1 million to $1.080 million, trying to increase it for inflation. And that's great. So you can write off that much every single year for taxes. Bonus depreciation is different. Bonus depreciation, you can actually go above that amount, right? And in bonus depreciation for 2022, the bonus depreciation amount is 100%.
Can you explain a little bit more in depth what bonus depreciation means?
Yeah. So if you think about it, Rob, let's just say that you're going to go, I don't know, you're a t-shirt maker and you get those presses, right? We've seen those. We actually have a friend who was doing t-shirts, and so we're getting these t-shirt kind of things and machines, and let's just assume that it's $1 million machine, and we expect that that $1 million machine is going to have a useful life of 10 years.
Okay.
Normal depreciation would say you write off $100,000 years, right? And then you end up writing off the whole thing over that 10-year period of time. Bonus depreciation allows you to accelerate that depreciation and write off in 2022 100% of it. So you could write off the full $1 million in 2022. Now that sounds just like 179, and it is, but bonus depreciation actually 179. So you could do both at the same time. And the key thing here in 2022 is not the 100%, because that's what we've had since 2020, since the pandemic. The key to this is that you can no longer look back in 2022, and you can't use the bonus depreciation to create the losses and go back and use it against other gains. It's only this year. So we've got to make sure that we're clear on that. The other thing is that in 2023, it goes from 100% down to 80%. And in 2024, down to 60%, 2025 down to 40%, and in 2026 goes all the way down to 20%. So this is about the time when we've got to be thinking, is this the year to make a capital purchase? Do we need to go out and buy new equipment, buy new machineries, buy new trucks, buy new stuff? If that's the case, we need to be really thinking about what year we should buy it and think about the cash flow, forecast that out, really make sure you have a capital expense budget for 2022, knowing that this is the last year you're going to get 100% bonus depreciation.
Yeah, as a business owner, December was always how many purchases could we make from a capital perspective to drive down that income. But if you look at it now, it's key to be making it this year and not in subsequent years due to the fact that that number goes down, correct?
That's right. And honestly, what you've got to be thinking about is you're forecasting out we're almost at the end of the first quarter. So you're going to be forecasting out second quarter, third quarter, fourth quarter. And in our TGG way, you'd actually start to forecast out first quarter of 2023. That's your income, but it's also, you want to forecast out your cash flow. You also want to forecast out your balance sheet. So you're knowing, hey, look, if we're going to buy this thing and it's going to be bought in 2022 or 2023, does it make a big difference for us from a tax standpoint? So it's having those conversations about forecasting out what we're going to buy, what we need to buy when you're fulfilling on your business plan. And if it means to buy it on December 31st rather than January 1st, it could be a big difference in tax for you in the year 2022. But if you have a loss, you might want to push it to 2023, even though you're only getting 80% in 2023. So there are reasons why you would want to do one or the other. The key is to be aware of it, right? And to know that it could go either way for you.
Well, I think when you say the key is, it's also the fact of planning, is putting together that budget, that forecast, planning out not just this month, this quarter, but looking 12 months out, so you understand what those purchases are, so that we could plan accordingly and then overlay some of these tax benefits that we're talking about today to really coincide with that strategy.
Yeah, as you know, Rob, our TGG way best practice is to forecast out and up 4 quarters in advance and to reforecast every quarter based on changing business environments. I mean, I'm not sure about you, but I sure didn't think we were going to get to 10% inflation. I knew inflation was going to happen. You don't dump that much money in the economy and not have inflation happen, but I didn't think 10%. I mean, that's a huge number that we're all dealing with right now. So it's very important, like you say, to make sure that you're forecasting and reforecasting.
Definitely. And speaking of that ever-changing environment and inflation, what kind of, when we look at like competition to hire people, is there a way to offer like other fringe benefits without potentially raising their wages?
Yeah, so a couple of big sort of tax law changes that don't seem like big changes, okay, but I think are big changes for us as business owners given the current environment, okay. And one of these is in that tax act, the TCGA, excuse me, that Biden passed. You can now provide family and medical leave to your employees and get a tax credit for years 2018, 2019. Okay. In addition, you can get that tax credit all the way through 2022 and through 2025. Okay. So let's just think about what this means. If we've got this great resignation, people want to work from home, can we give them a benefit and not really cost ourselves any money because we get a tax credit back for it? This is one of those things. If you had the example that I would use, and again, it's a very over the top example, but if you had all female employees, for example, or all employees that were aged 25 to 40, you'd have a bunch of people in that, family starting age, right? And so this could be a really important benefit to them. And if you can give it at basically no cost because of the tax credit, this could be a differentiator on why they pick you or stay with you rather than going to somebody else. Other things that you can think about is when you go into the retirement plans. Now, look, the retirement plans have consistently kind of increased their limits. And so we got another, increase as a result of inflation again. And so you go all the way up to $20,500 for an individual contribution, for example, to a 401k, and the combined employer-employee goes all the way up to $61,500 from $58,000 in 2021. That's great. Challenge is the catch-up provisions you used to have at $6,500 stayed the same. So if you're going to use your 401k as a retention tool and you have older employees, you're not really getting much bang for the buck, right? That didn't change. So you really want to think through kind of where some of these things are coming out. And other ones that are just simple and easy are things that again, may not make a ton of sense for everybody, but I'm going to say something that's going to be a little weird, Rob. Because most people won't think it applies to them. The parking allowance and the mass transit allowance went from $270 to $280. And if you're not in a big city, New York City, San Francisco, parking doesn't seem like it's that big of a deal, whatever. Why is this important to me? Well, you could give a parking allowance to people at $280 per month that is tax deductible to you, non-taxable to your employees, and not hit with any payroll taxes. So if you think about it in terms of what does that mean, let's just do some basic math. Per employee, you're going to be, getting as much as maybe, I don't know, $6,500, $7,000 per year of actual compensation you can get to them without any income tax, without any payroll tax burden. So just right there by itself, you're probably saving as much as maybe $540 per employee per year. So these are little things that you're like, oh, it's not much of a big deal. It went from 270 to 280. And I don't even have parking for my employees, but maybe you just give them this parking allowance as an alternative form of compensation to start being able to compete out there in the marketplace in a different way. And so these are just lots of little things that I think add up to being able to help.
Yeah, I think it's those fringe benefits, is putting together a compensation package from, work remotely, looking at tax benefits, all these different areas that end up adding up to a full comp package to your team that can separate you from your competitors.
Yeah, no, absolutely. I mean, look, Rob, we do it at TGG, right? We have a student loan repayment program. We have a 529 plan that our employees can participate in. We have all kinds of fringe benefits like, discounted gym memberships and, discounts for Audible. We're trying to do anything we can and everything we can to support our people. And the more ways we can see things to do that don't involve payroll taxes save us money. And so any way we can really feed to our employees more compensation with less tax, it's a good thing.
Definitely. Well, I know this one hits home for me as a past business owner when they made this change, but going from the meals from 100% to 50% now back to 100%. This was kind of a change in my GL account, making sure that we separate all those, and being on the sales side, taking clients out, taking team members out. Talk to me a little bit about this change.
Well, I was reading a funny article, sort of studying up for today, and it was an article from one of the big 4 CPA firms, and they basically said, you should go out to lunch every day and pay for your people's lunches and do all this kind of stuff, because that's another way, again, that you, because it's now 100% deductible, any meal that's associated with business is 100% deductible, but this is the last year you get it, 2022. It was 2021 and 2022. So really make sure you're taking advantage of this to the maximum available possible. And like I said, if you said, hey, look, when you come to the office, we're going to have lunches for you, and that's an extra benefit that your employees are like, that's awesome. That saves me money. Is that another way to provide compensation that has no tax to it? Right? That's another, it's silly, but it's another one of these little, what I'll call, there's death by 1,000 cuts. I like to say this is success by 1,000 cuts, right? It's $540 here. It's $200 there. It's multiplied by all your employees. If you're getting to $1,000, $1,500 of savings per employee per year, that can be a huge number.
No, it definitely can. Looking at the charitable contributions, we talked a little bit about this yesterday, and I found it fascinating how you took a complex tax law in terms of how to deduct charities and shifted it over a little bit. Talk a little bit about that and how is a better way to deduct.
Yeah, so I'm gonna just set the stage here for a second, because I think this is so stupid, right? I just think the tax law on this is really, really backwards. At the end of the day, you would think the government would want businesses to be donating to charitable organizations, because it would support the health and vibrance of our culture and our society and whatever, right? And all these great things that our charitable organizations do. They don't make it easy, right? So I'm just going to tell you what the rules are. A C corporation can deduct up to 25% rather than the last 10% of its taxable income. That's for 2022. Great. Businesses donating food inventory can qualify for deductions of 25%, up from 15%. This is applied to S Corps, C Corps, and everybody else. But it's like all these little, if you're donating food, but not clothing, if you're donating clothing, come on, all right, let's make this super simple. What if instead of calling it a donation, we call it a marketing expense, and we go to the charitable organization and we say, this is what we do. I don't care if you're doing Meals on Wheels and you're talking to people in the bus. I don't care if you're, doing the soup kitchen and talking to people. If you're building a house for Habitat for Humanity and you're saying, yeah, hey, we're TGG, cool. Any donation for Habitat for Humanity, you can just call it a marketing expense. Then you get 100% deduction. You don't have to jump through a bunch of hoops or worry about convoluted or complex kind of, was it food? Was it clothing? Was it, what was it? And what do I qualify for? It's 100% deduction if it's marketing expense. So I see this all the time when people are giving to charity and we look at their financials, and I have to ask them, is this marketing or are you doing it out of a charitable intent? If it's purely charitable intent and you're a business owner and you own 100% of the company, you probably don't want to do it through the business because there's too much complexity. Do it on your own personal. If instead you're thinking about it as a quasi-marketing expense and you want to get 100% deduction for it without a lot of like hoops to jump through, just call it a marketing expense and move on.
And would you put that in the marketing account or separate those, but keep them still as marketing? How would you do that from a GL perspective?
It's a good question. I think you do it in the marketing primary account, but you create a sub account underneath that. So for example, under marketing, you might have digital marketing expense. You might have newsletter expense. You might have events expense, and you might have charitable expense, right? And so you can put it under as a sub account underneath marketing. But also, to your point earlier, this is also something you're going to want to make sure that you are forecasting. It's an expense. It's real cash going out the door. So make sure it's part of your business plan.
Makes sense. So we were talking a little bit earlier on offering employees family medical leave.
Right.
Are there any other benefits that someone could offer without necessarily having to raise their wages? Like when it comes to that,
well, the one that I talked about is like that parking and the mass transit thing. There are a whole host of other ones. For example, you can do, the mileage reimbursement rate went up for 2022. Okay, we're up to, I believe it's 58 cents a mile.
You touched on the student loan repayment. I know we're doing that at TGG. That was the one I was kind of thinking.
Yeah. So again, yes, you could do things like a student loan repayment plan. Okay, that's something that you can absolutely do. That can be prepayment or pre-payroll taxes. In our case, there is a credit for doing this of up to $6,000 per employee per year. So you can exempt, again, $6,000 per employee per year from income tax to them, or from payroll taxes as well. These are great things. So if you're paying somebody just to get, let's say that they need $100,000 of salary, that's what they're asking for. You can take their salary down to $94,000, pay off $6,000 of their student loan. They don't get taxed on that money. You don't have to pay payroll taxes on that money, and you're out 100 grand. You're actually saving yourself money, saving them money, and paying off their student loan. Again, that's success by 1,000 cuts, and that's how we do it at TGG. And I think these things, again, depending on your workforce and who you have, these things could be very beneficial. The other thing I was going to say is you can do something like a mileage reimbursement plan, or you can just do a straight mileage plan and say, hey, listen, we're going to give you an auto allowance of $250 a month, right? Or $400 a month.
And is that auto the same category there when we talk about?
Do you mean the same category of kind of those types of things where you can end up giving? Yes, it's exactly the same kind of thing, because instead of giving a reimbursement, you're actually saying, here's your allowance, right? Well, that's another one of these ways that you can add to their compensation and their quality of life without increasing payroll taxes. So it's all good stuff.
So what about, we're talking about benefits on that side. What about people on the call that have children? Any benefits that you can do that through the business?
Yeah, so it's kind of interesting. The old thing that we used to do, I don't know, 5-10 years ago, is you could put your kids in your company and exempt a lot of their income from income tax. You can still do some of that, okay? But what I would tell you is a lot of that stuff is earned income, right? Well, what if you wanted to put your kids on payroll and unearned? Well, the first $1,150 of a child's unearned income is tax-free. So for business owners, you can put your kids down on your company and, again, have income flowing through to them on a tax-free basis of up to $1,100 per year. So again, not huge numbers, but we're talking about success by 1,000 cuts. And this is another one of the ways to cut more income tax out of the system.
So that there is your allowance that you're giving your kid every week is now paid through the business and tax-free.
Exactly. That's exactly right.
So in terms of kids, we also just got a message of someone on self-employed. So have there been any changes to people that are self-employed, and what do they need to know?
So yeah, I think the self-employed stuff is really important. Again, this could be a single member LLC that you're filing on Schedule C, or it could be, in fact, that you are truly a self-employed person without any entity, and also filing on Schedule C. So there's two things that I think are really important here to consider. The first one is the mileage rate that we just talked about. It went from 56 cents to 58.5 cents a mile. So it's important, if you're self-employed, you can get a tax deduction for literally every mile you drive for business purposes. And I don't know, you and I, Rob, have been entrepreneurs since day one. Is there a mile we don't drive for business purpose? I mean, we're on the phone talking to somebody doing something. So, these are things to think about when you're self-employed. The other thing is, and I'm going to talk about this as a benefit to self-employed people, but I'm also going to kind of twist it on its head a little bit, just so we can look at it a little bit differently for companies that are not self-employed people. So first and foremost, if you're self-employed, make sure you're taking your home office deductions, make sure you're getting the mileage that we talked about, the meals deductions, all these kind of things that are hugely important to you, because any of your net income is you're going to be paying both sides of Social Security, right? So you want to make sure that you're doing that. The other thing that I think is really important here is if you were in a business that is starting to hire people remotely and across the country, or in states that don't have real strict 1099 rules. California does have exceedingly strict. New York, Arizona, these are places where you don't want to try this. But if you're, for example, in Texas, right? A lot of people moving to Texas or Tennessee, they encourage 1099 workers. And you might want to hire someone as a 1099 worker so that you don't have to pay payroll taxes, which sounds like you're just trying to avoid payroll taxes. But maybe they can actually make more money at the end of it, because they could get the home office deduction. They can take the mileage rate for themselves. They can write off their business meals. They can write off other business expenses that otherwise they can't write off as your employee. So there is a new way to hire where you could go to people and say, would you like to be a W-2 employee or would you like to be a 1099? And here's the differences and see what's better for you. Maybe that's another way that you can attract and retain top talent.
No, that makes sense. And I think that really separates a lot of companies in how they look at their hiring process.
Absolutely. Absolutely.
So, Pat, going on from the self-employed, let's try to hit the mass audience for some of the questions that we're getting. What are some just overall general tax changes that everyone can benefit? I know we talked a little bit yesterday on the estate taxes and cap gain changes. You want to go into a little bit more depth there?
So you cut out just there for a second there, Rob. Can you just say that one more time?
Yeah, so I was saying, we touched on a little bit on the self-employed, but want to kind of reach the mass audience here and talk about some of the general tax changes that happened. Yesterday, you and I kind of kicked around some of these ideas from estate tax changes to the cap gain rates changes. So I want to kind of touch on those points.
Yeah, so I mean, look, a lot of these things just went up based on sort of cost of living adjustments, but they're still there. So from an estate tax standpoint, if you're single, you've got an exemption of $12 million, $12.06 million to be precise, right? And that went up for tax year 2022. If you're married, you've got 24.12 million that is exempt from estate taxes. This is great news for business owners who want to pass the business to their kids or haven't quite gotten around to their buy-sell agreements. I want to use this opportunity, Rob, to highly encourage everyone to think through a buy-sell arrangement of some sort to protect against what I call the 4 Ds. D number 1 is death. That obviously impacts the estate taxes. If you had to sell the business to pay estate taxes, this would be a problem. So you've got to make sure you're thinking that through. The second one is divorce, right? What is going to happen if you get divorced to the business? This is something you should prepare for ahead of time. Unfortunately, it's a 50% divorce rate in this country. This is not something that you want to have happen, but you got to prepare for it. Third is disability. And I'm not talking about like you get in a car accident and you have a broken leg. I'm talking about mental incapacity. I mean, it's sad, but I just read the news this morning that Bruce Willis is no longer going to be taking acting gigs because he's got some degenerative brain disease. And so, he's 67 years old. That's young. We got to be thinking about this stuff. And the last one is dissolution, which is just what are you going to do to dissolve the business if you want to unwind it? So as we're thinking through these things, make sure that the estate tax triggers this thought in your head of planning for the 4 Ds in buy-sell agreements: death, divorce, disability, and dissolution. And those are important things. Capital gains rates are still the same, 15 to 20%, but the limits are a little bit higher. You don't hit the 20% bracket until you get to about $445,000 of cap gains income. And then same thing with the tax brackets. They're still top individual tax brackets, still 37%. But the income levels for each bracket shifted up just a little bit. So those are kind of good little benefits for everybody, but there wasn't any massive changes on that side of things, Rob.
Yeah, no, but I think those are still key factors to take a look at.
Yeah.
We got a question that kind of pertains to the last topic that we discussed, and it was the benefits that you were going through. Can you pick and choose employees, or do you have to offer this as a broad across all employees?
So great. This is a great question. The 1974 ERISA Act governs all qualified plans. Qualified plans are plans that require participation of all employees on a more or less level basis. So those are things like your 401k, your health insurance, stuff like that. But when you're doing fringe benefit kinds of things, or if you're doing auto allowances or something like that, you could give an auto allowance to a salesperson and not to a factory worker. So you get to pick and choose with some of these things. And you can pick individual people when it comes to some of these unique type of benefits.
And that's probably what allows you to separate yourselves in a recruiting perspective. So it's not just competing against salary. You can now get creative with these fringe benefits to really separate yourself from the pack.
That's right. Just make sure you're checking again with your attorneys on what you're doing. I'm not an attorney, I'm not a CPA. These are just things that we're trying to do to help you spur some ideas and spur some thought.
Awesome. Well, we did talk about some positive things so far, but we always not know that there's a flip side to that coin. I don't want you to be the bearer of bad news, but give me a couple things that probably aren't as positive to our business owners. That we
Yeah,
should
I think
be aware
unfortunately, there's two things that one, hopefully we don't have too many people in this situation, but in 2020, you were allowed to defer your payroll taxes out into the future, right? And as part of the Coronavirus Relief Act, you could go and do that. And you could defer them out into 2021 and 2022. The challenge is that if you did that, your entire balance is due by December 31st, 2022. And again, if you don't pay up on all those payroll taxes by 12/31/2022, the IRS is going to go back and assess penalties and interest on all of the payments you missed. So really be mindful. If you were one of those companies that deferred payroll taxes in 2020 because you got shut down, you had a tough time, whatever it is, make sure you have a way to find that money to pay it back before the end of the year here, or you're going to get smacked with some huge penalties.
Yeah, we were just working with one of our clients the other day on their 13-week cash flow, as we wanted to make sure we properly allocated enough funds to pay that back come 12/31. So any business owner out there that isn't have clear visibility into their cash flow, it's a positive thing to understand and prepare yourself for large lump sum payments like this.
Yeah, no, we got to make sure that we're ready for that stuff. It was nice to get a break from it in 2020, but the piper came around and they're here to collect on the taxes.
I know we're all hoping they would just forget, but that's usually not the case.
Not with the IRS. What is it? Death and taxes, two things you can guarantee out in life.
Exactly.
Yeah, the other thing that's been, and there's a lot of uproar around this thing, and I understand why, because there's some privacy issues here, but it's this whole Venmo, PayPal, $600 stuff. Okay. And so what this is any digital payment platform that has got a $600 or more, you receive money or you pay money to somebody that's $600 or more, you need to get their social security number, because you actually have to report that to the IRS. And what that also means is that if you're selling on Amazon, Etsy, eBay, one of those, and you're doing more than $600 worth of business, you can expect to get a 1099 from them for that business. So these extra reporting requirements are going to be a big pain in the ass in January if you haven't gone through and made sure you're disciplined with collecting those tax ID numbers and addresses and contact information as you pay people. So just a reminder that is another admin thing you're going to have to make sure you comply with.
You mentioned it's a $600 threshold. So once you start paying anybody over $600, they're going to be needing a 1099.
That's right. And so, yes, that's exactly right.
All right. What about businesses with loans? I know there's a couple changes there.
Yeah, this is really only for larger businesses. So if you're a business under $26 million, you don't have to think about this, but that is the limit for 2021, 2022. So gross receipts exceeding $26 million, you have interest deduction limitations. So again, as part of the previous pandemic relief law, the deduction limit was bumped up to 50% from 30% of the taxpayer's adjusted income. So you could deduct more of that interest. However, in 2021 and 2022, the previous 50% rule no longer applies, and we go straight back to the old 30% rate again. So if you've got a business that's doing more than 26 million, you might have an interest limitation on how much interest you can actually deduct in this year. So you might want to think about, look, what are we going to do with our financing? When you're making these financing choices, does the interest we pay, is it all going to be deductible? If not, are we doing it the right way, or should we look at doing it a different type of financing? And maybe think about partners, or maybe thinking about selling part of the business, or maybe think about private financing with different types of interest structures. So lots of different ways to do it, but you want to make sure that you're not getting caught in that web where it was deductible and now it's not.
Yeah. Again, focus on planning and looking in that future.
Yep.
I know this was applicable to us. I believe you are calling in from Austin, Texas. Previously headquartered in San Diego, we made the migration out of state. What are states like California doing when a lot of these companies are getting moving out of state?
So there are a bunch of states that are suffering due to the limitation on what were called the SALT taxes, state and local income tax deductions. And as a result, high income tax states like California, New York, places like that have seen a migration out, and places like Wyoming, Idaho, Tennessee, Texas, like you mentioned, Florida, where there's zero income tax, have seen this massive migration in, right? And that's because the income taxes are just crazy. So like in California, for example, you got a 13% rate. Well, California passed this thing called AB 150. And AB 150 is aimed at getting around the SALT deduction. And it sounds great on its surface, because basically what you do is you turn your California state income tax payment into a deductible expense for the business, reducing your net income. Again, all sounds great, except it really only applies to the top 3% of it. You're really getting about a 3% benefit on your taxes or less. It actually ends up being much less than that, because what California requires you to do is to pay a minimum tax of 9%. So no matter what, you're still going to end up paying California a ton of money. And then the federal government doesn't allow you to take all of it off of your return. So you can only take the portion between 9 and 13% off of it. So what is that? If you're in the max tax bracket, let's just say it's 37%. It's 37 of 3%. It's like literally getting a 1% benefit. So at the end of the day, it sounded awesome. And then when I ran all the math, I was like, okay, that's not really saving us any money.
The devils are in the details, as we mentioned before. Success by 1,000 cuts, but also on the flip side, sometimes you got to look in there.
Yeah, so that was one that again I was hopeful, but there's a bunch of states that are passing these kinds of rules, and oddly the IRS has blessed them. But it doesn't mean it's going to provide any tax savings. It's one thing to hear the headline. It's another thing to actually go through and do the math and figure out in your situation, is it going to save you any money? Because again, as to trends that are going on in the workplace, remote work, workers working from home, all these kind of things, I know a lot of business owners are thinking about redomiciling in tax-free states, a lot of them. And it's very important to do the math and understand what it's going to take and what it's going to mean to do that.
Being in a lot of entrepreneur networks, I see a ton of companies moving out to more tax advantageous states, and also looking at a lot of things that we discussed today, from the fringe benefits to try to bring in better quality talent, but getting more creative with it. That's both advantageous to you as the business owner as well as to the employee.
Yeah, that's right. That's absolutely right.
Well, great, Matt. Well, I got a couple questions here, so I'm going to kind of open it up, and maybe you and I can spitball on some of these. But
Sure.
One question we had from one of the audience members was tips for startups for this tax year. Anything that we touched on? I know fringe benefits to me is a big one, is being able to attract great talent. And as a startup, cash is king. Really being able to manage that, but also trying to bring in that big talent. If you're in tech, you're trying to compete against the Googles, the Facebooks of the world. How do you compete with them in a different, more creative way? So I think some of those items. Any other tax tips that you would suggest?
Well, I think it just depends on what kind of a startup you are. But one thing that I think every business can think about here is the R&D tax credit. The R&D tax credit is extended 22, and startups should absolutely be looking for this as a credit to take for any kind of research and development activities that they have. And it's a much broader categorization than you would think. So again, we've got a number of CFOs who are really good at this stuff, and I think excuse me, I think that R&D tax credit is something that startups and every business, frankly, should be really looking to take advantage of.
And I don't know much about this one, but I know you do, Matt. We've helped a lot of our clients. What about the vaccine credit that has been available this last year or so?
So that all expired.
Oh, did. That's why I said I don't really know much about it. So that's
all that stuff.
I've thrown it out there.
Yeah, well, that's why we were screaming about it last year,
yeah.
Right? Because it did all expire at the end of 2021, and so these are things that we want to make sure everybody's. This is why we do this kind of stuff, Rob. Is we got to make sure that everybody knows what's current, what they can do today, and they don't miss out on things.
Yep. Another question. I just hired a CPA in Colorado. Should I switch to a CPA in California where I run my company so they're more knowledge about California laws?
Okay, this is not an easy question. The where you are taxed on your business, I have heard about every answer I can think of. I have heard the answer: you're taxed where you actually provide the service. I've heard you're taxed where you deliver it to. I've heard you're taxed where your customers are located. I've heard all kinds of things. Okay. At the end of the day, you need to work with your CPA to determine what states and which states you might have tax, what's called situs in, right? What states do you actually have to file tax returns in and why? And make sure you get more than one answer. I'm just telling you, this stuff is very complicated, and a lot of CPAs do not specialize in this sort of multi-state stuff. So you really want to ask around, do some research and find out, because there's no right answer to this. If you live in Denver and your employees are in Irvine, do you need to use a California CPA? No, you can use a CPA from Denver. They just have to be familiar with multi-state issues and understand what percentage of your income is going to be derived in Colorado and taxed under the Colorado regime, and what portion of it is going to be earned and then required to file a tax return in California.
Yeah, that's very helpful. And I think that the key is looking at where you're doing business and getting multiple different sources to get feedback. I know through my years talking with different CPAs, there's different strategies, different ways of looking at things. So getting those expert opinions definitely help out.
Yep.
Next question. Did the American Family Act providing child care assistance pass? And I know we're getting pretty tax in depth here, Matt, and I know you're not a CPA, but not sure if you knew that. I'm imagining you're Googling it right now.
I am literally Googling it right now.
I
don't know. I don't know whether it passed or not. I'm just looking to find out. So I'm not the right guy to ask on this one. I apologize. I'll tell you when I know something and I don't know. It looks like it did pass. I don't know. It says here that it provides up to $4,000 to cover expenses related to childcare, but I think that's on an individual basis. I'm not sure what it does for businesses.
Yeah, so I want to kind of throw something out there. If anybody wants to throw their email in the chat, Matt and myself are happy to spend 30 minutes with you talking through any questions, doing a financial review, giving you feedback. I know as a past business owner and past client of TGG for many years, Matt was a great mentor of mine and really helped me view my business in a different way than I'd ever seen before. So we definitely want to offer that out to any of our audience members today, that feel free to throw your email in the chat, and Matt and I will sit down with you for 30 minutes and go through kind of different opportunities that we see. Well, I know we're kind of coming to an end here, Matt. I wanted to see if you had any other tips, tricks, comments. I know you gave us some great information, and I mean, I love this saying, death by 1,000 cuts or success by 1,000 cuts. None of these are going to just absolutely change the way you're doing business, but it's saving $1 here, adding a benefit there to our client, to your employees. And really, when you put these all together, it really adds a ton of value to the way you're growing a business.
Yeah, I'm not sure I can say it much better than you just did, Rob.
Yeah.
I really believe that the tax law is what it is, but how you choose to operate your business in the current environment to get the most out of it is what's important.
Perfect. Well, I don't see any other questions coming in. We can stay on to see if anything else comes through. I see one. If I live out of state and sell our California house, do I have to pay California state tax on that profit?
Yes.
I was going to say yes as well.
Yeah, that's a pretty simple one.
Yep.
I don't have to be a CPA for that one.
Yeah. So after this, we're also going to be sending out this recording to everybody within the next 24 hours. So you're welcome to rewatch if Matt got a little too in depth with some of those tax codes and you want to refresh that, or feel free to reach out to myself, Matt, or anyone at the TGG team to jump on a call and help you navigate these waters. Well, Matt, I really appreciate your time today, and thank you for sharing all your expertise. What was it, 2,000-page tax thing? I imagine you read every single word, and we're very knowledgeable, and we appreciate you sharing everything with us.
Thank you, Rob. I appreciate that.
All right, everybody. Well, you guys have a wonderful day, and talk to you soon.